At the clock, it's 10:30 a.m. And I will call the Surgeon Water Board Pension Committee meeting to order. Special Counsel Grinstead, please call the roll.
Director Pacho?
Here.
Director Taylor? Here. Director Johnson? Director Guzman? Director Scholas?
Here.
Mr. Heller? Mr. Davis?
Here.
Ms. Matthews? Here. Mr. McBool?
Here.
Chair, we do have a quorum.
Okay, thank you. We have two presentation items on the agenda this morning. First item is the executive summary of the first quarter 2022 market performance and 2022 outlook report from Marquette and Associates. I assume Mr. Kwaku will make that presentation.
Correct.
Please proceed. Thank you.
Great. And good morning, everyone, first and foremost. And I know I said this virtually, but again, thank you so much for the confidence in Marquette. Looking forward to many more presentations and many more discussions with all of you. I have a hard copy of the book, so just from a logistics standpoint, just wanted to confirm, okay, someone will be driving, right?
You can drive, please.
Oh, I can drive? Okay, perfect. That's even better. Thank you. All right, thank you. All right, so this being the first meeting in person I have with you all, just wanted to do a quick time check. I want to make sure I'm mindful of what else is on the agenda. Roughly how long would you like to hear from me? And once I get the number, I'll make sure I accommodate.
I think we have already allowed what?
Yeah, 20 to 25 minutes is
Right,
be fine.
perfect. So 20,
That's
25
good.
minutes.
That's
And
good.
I think the goal here will be to go through the executive summary, talk through performance in the portfolio, and then if there are any further questions, there is a performance report that we can dive deeper on, if that works. Typically, my voice is pretty loud, but if you need me to speak up, please let me know.
I think you're fine.
And Chair, this also will count as a trustee education. So if
Right.
you go, so we need an hour, so this will count as trustee education.
Okay, perfect.
Thank you.
All right, so we begin with this first slide here. Commodities continue to outperform. And this periodic chart does a really good job of just underscoring why diversification within portfolios makes a lot of sense. You'll see year over year, there's somewhat a good degree of inconsistency in terms of which asset class is going to outperform and which asset class is going to underperform. The one, I guess, more consistent underperformer is commodities, and the outlier right now is commodities performing exceptionally well in 2022. So the takeaway here is, as we talk about asset classes, as we talk about asset allocation, our goal is never to time the market. Our goal is to make sure that we kind of understand the asset classes don't always move in tandem with one another. Mm-hmm. And the goal is to make sure that the portfolio is adequately diversified just to lower volatility as volatility is increasing in another segment of the market. Commodities, once again, are doing exceptionally well. We'll talk about why momentarily, but there's definitely no recommendation here to load up on commodities or put the portfolio in commodities just because commodities are having a good period of performance presently. With respect to 2022, it definitely has been a pretty challenging year for everything other than commodities, bank loans, and then real estate. All of the major asset classes other than the three I just mentioned are basically grappling with negative territory in 2022. So I'm going to jump through a few pages and jump to market themes. And the key themes for 2022 are basically on this page. Inflation, we've seen inflation creep up to the highest level in over 40 years. We've seen the Fed commit to combating inflation through interest rate hikes. The Russian invasion of Ukraine has also increased the number of shock points or volatile points within the market. We continue to see, amidst the sea of volatility, stock selection, particularly with certain active managers, looks like it could be paying off. Alternative asset classes, and we'll talk about this as we go through the asset allocation. Alternatives continue to be attractive when we think about risk mitigation, diversification, and then also concerns around investing in an inflationary environment. Limited opportunities in fixed income, and we do have the folks from Pyramis in the room, so I'll really just tee up some talking points for them. Fixed income, as we know, is one of the asset classes that did exceptionally well in 2019, 2020. 2021 was an okay year for fixed income. A lot of that was really driven by interest rate policy in 2020 and 2021. 2019, the flight to safety that took place also boded pretty well for fixed income. But presently, the major headwinds for fixed income are interest rates going up. There's an inverse relationship between the value of a fixed income instrument and an interest rate level. So interest rates go up, the value of fixed income, most types of fixed income comes down. And then ultimately, inflation is also erosionary to fixed income. By its very name, it's fixed in its income. It means that inflation will erode the real value of that fixed income instrument.
Before you proceed, if you don't mind going back to the first slide,
Yeah, absolutely.
the periodic table.
Yeah.
As far as our portfolio concerned, can you break down the percentages based on commodities and other real estate, where our portfolio stands?
Yeah, absolutely. So the portfolio has approximately 31% in fixed income. This is as of the end of April. So 31% in fixed income, 29% in US equities, 23% in non-US equities, hedge funds 8.2%, real assets, and this is really the REIT exposure, that's 9.5%, so we can round that to 10%, and then cash.
What was 9.5?
REIT exposure, real assets. And then there was a residual cash balance of $500,000, which is, rounding down to 0% of portfolio assets.
Okay.
And one of the things we'll talk about is the approved asset allocation and the transition to the approved asset allocation. So
based on your periodic table, we don't have any percentage in commodities.
So commodities, it's not a quick no, because commodities do represent a portion of the indices. So energy, for example, is part of the large cap index. Other commodities will be part of the index exposure. So we don't have what we call direct exposure to commodities. There isn't a commodities fund. However, there will be exposure to energy through the index funds, the S&P 500, for example. Whatever the index weight is in energy, we would have that exposure. So we will have some exposure, but we haven't consciously looked to select a commodities fund or a commodities manager. But as commodities do represent a percentage of the markets, we do have market weight to commodities.
Would you have that breakdown in another report coming up? Or
so the breakdown, I can give that to you super quickly. So in our performance report, our commodities exposure, and by commodities, I'm going to go with energy as the proxy. In the overall equity composite, energy represents 4.5% of the equity composite exposure. And you will be able to see this. For those of you that have the electronic copies of the performance report, there is a quarterly book, and the quarterly book does have characteristics. Those characteristics do break out the sector exposures of your managers as well as the benchmarks.
okay, thank you, sir.
Yep. All right, perfect. So with respect to some of the key themes that we have been talking about, inflation is one of those key themes. So inflation, CPI, the Consumer Price Index, that has continued to surpass expectations. With respect to surpassing expectations, that you can take that with a little pinch of salt. We had $5 trillion of stimulus spending that took place in 2020 and 2021. ultimately the net effect of that is going to be inflation rising up. I think the unexpected component would be the Russian invasion of Ukraine, Russia, Ukraine, oil-producing geographies. If there is any type of supply disruption, that would lead to an increase in oil prices. Oil, energy have been the biggest component of the CPI increases. So really here, the takeaway is inflation has exceeded expectations, and for the time being, we do anticipate inflation is something that we will be grappling for the foreseeable future. The Fed did raise interest rates last week. 50 basis points was the rate hike, and the Fed in its rate hikes is ultimately looking to combat inflation. In terms of the relationship, why would a rate hike combat inflation? When we think about when interest rates are low, well, when interest rates are low, it's easy to borrow, it's easy to spend, it's easy to expand if you're a company, if you're a consumer. When interest rates go up, suddenly those decisions around extending credit or buying something relatively cheap, those decisions are deferred a little bit more. The less spending there is, the less inflationary pressure we see within the economy. So that's really the Fed's rationale for increasing interest rates to combat inflation. So with the US economy, inflation is definitely the key talking point. And it's interesting how things do flip-flop, right? You see right at the bottom of that particular slide, the BA2 variant of COVID, that's the last thing that's mentioned. So right now, it appears that inflation is at the minds of investors more than COVID is. I don't know if that will flip-flop at any point during the year, but presently inflation is the key talking point and literally what everyone on the street is talking about presently. With respect to the economy, and we'll talk about this a little bit more when we look at the fixed income section, the economy still is in somewhat fragile territory. Interest rates going up, that will obviously have an impact of slowing down some economic activity for the reasons I just gave earlier. But then when we think about the yield curve, the positioning of the yield curve, we'll see momentarily that the yield curve is also in an interesting place. I know my peers at Pyramis can add a bit more color on that, but the yield curve, if you look at the shape of the yield curve, any type of dipping at the long end of the curve would lead to a yield curve inversion. Yield curve inversions are typically a predictor for recessionary factors within the economy. So with fixed income was down for the month of March as well as the quarter, down 2.78% for the month of March, down almost 6% on a year-to-date basis. These types of numbers, if we were looking at equity managers, they would be more than tangible. But since this is fixed income, these are pretty significant numbers when we think about fixed income typically being an anchor, a ballast within a portfolio. It's not typically a source of very strong returns. The returns we saw in 2019, 2020 from this asset class were definitely, positive right tail event types of returns. So ultimately, these pretty meaningful losses we're seeing from the fixed income market, we would consider those to be pretty extreme. They're also extreme for a number of other reasons. The equity markets, as we'll discuss momentarily, are also going through losses. And typically when the equity market goes through its loss or its pullback, we'll typically see fixed income hold its own in value. But this environment's a little bit different where fixed income is also losing along with the stock market. So that's a pretty meaningful observation from this particular page. With respect to this particular slide here, expect more flattening as the Fed takes rates higher. I spoke earlier about the yield curve and the shape of the yield curve. If you look at the colors are a little bit off, but the top line, that's like a darkish blue. You see here that the shorter end of the yield curve, we do see a spike up at the shorter end of the yield curve. That's what the Fed does have control over. The longer end of the yield curve is really market sentiment. It's supply and demand, market sentiment that will really lead to where interest rates set on the yield curve. So we've seen a huge spike up at the short end. At the longer end, the concern is if there's any type of dip at the at the longer end, specifically between the 2 and 10-year maturities, again, that's typically an indicator for economic activity slowing down. So, in the coming weeks and the coming months, if you're hearing or reading more about the yield curve and the shape of the yield curve, it's for that exact reason. The yield curve has typically been a pretty good predictor of recessionary environments. So moving ahead to the stock market has definitely gone through some major challenges. Now, one of the things I like to do is put performance in context, right? I'm a big believer in mean reversion. I feel that for everything that goes down, there's a point where it has to come back up. For everything that goes up, there's a point where it has to go down. And that's literally the theory of mean reversion, right? Everything can't go up forever. Everything can't go down forever. And when we think about the stock market has gone through some really interesting iterations over the last couple of years. The stock market went through a significant sell-off in the first quarter of 2020. But as we just mentioned momentarily ago, the stimulus spending, the $5 trillion in stimulus, interest rates going down, that had the effect of really just gearing up the stock market. And what we saw in 2020 and beyond was a pretty interesting trend where the market sold off, but it wasn't value stocks that rebounded. It was growth stocks that rebounded. And that really just pointed to the continued aggressive sentiment of investors in the market, and the fact that low interest rates, the fact that stimulus spending incurred those to spend on tech stocks became more attractive than value stocks. We ultimately saw a pretty strong peak for the equity markets in 2020 as well as 2021. So part of the coming down of stock returns, we can put that down to mean reversion, right? There's only so much Peloton and some of these other stocks are going to grow, particularly based off some of the valuations they've been bought at. The other thing we're seeing here is, the slowdown, the concerns that also are impacting the fixed income market. Inflation, once again, is a concern. Interest rates going up does increase uncertainty in the market. The market doesn't like uncertainty. And then the other thing that we're really seeing is that strong rotation away from growth stocks into value stocks. So really quickly, if we think about a growth stock, you can think about a company like a Tesla. It's a growth company. The earnings are, not as steady, not as reliable as that of a value company. The growth company is attractive because it has a very attractive strategic vision. The goal is to hit 1 or 2 home runs over a long-term time frame. And then the value stock is really a type of stock of an established company. Let's think of a Johnson & Johnson, very mature product lines, pretty predictable in terms of supply, demand, elasticity, and so on. For whatever reason, value stocks were not in favor in 2020, but in 2022, value stocks have definitely come into favor pretty significantly versus growth stocks. And typically, value stocks will do well when economic prospects seem decent. But in this particular instance, where economic prospects are still somewhere in the middle, the rotation into value is, somewhat of a duration play. Growth stocks have a longer duration, and they also pay less dividends, making them more sensitive to interest rate hikes. Value stocks pay more dividends. They have shorter durations, making them more attractive in this rising rate environment. Now, the one thing I'll point to on this page is the 10-year number. And the 10-year number, I always like to focus on that because at the end of the day, we are long-term investors. There's a lot of noise in the market, and there can be a lot of pain in the market, particularly over the short term. But over that 10-year period, we're looking at pretty exceptional returns coming from the stock market. So just as an example, the average, or I should say the annualized 10-year number for the S&P 500 as of the end of March was 14.6%. The mid-cap index, 12.9%, and the small-cap index, 11%. Really meaning that in the US stock market, the average annual return for all of these indices over the last decade has been in the low double digits. So again, exceptionally strong returns coming from the stock market. We fast forward to where we are today, exceptionally strong returns in the double digits does point for at some point stock returns coming down. So while it's uncomfortable, while it's not pleasant to look at the stock market exhibit so much volatility today, again, it seems very logical that stocks are behaving how they are behaving today. They can only go up so much, particularly in this environment where rates are being adjusted by the Fed. Okay, I'm going to jump ahead to non-US equities. And again, if there are any questions, please stop me along the way. But non-US equities, like US equities, have also had a pretty tough 2022. For the first quarter, on a relative basis, non-US stocks slightly outperformed US stocks across many of the major indices. Now, the one area I'll point to on this chart is the, it says developed market indices, the EFI index, and then the EFI local. This is always a really good exhibit to reference, or this is a good statistic to reference, because it really points to, in times of volatility, how the dollar can be beneficial, given that it is a currency of last reserve. And we see here the EFI index, for example, over the 1 month period, over the 6 month period, it's a 0.6% return. But then we look at the EFI local return, and it's a 2.1% return. The takeaway here is when you look at the investments of an international stock, once you translate those investments into US dollars, you're actually looking at a relatively lower return. The reason for that is the appreciation of the dollar. So the appreciation of the dollar is still continuing amidst this volatility we're seeing in the marketplace. And for some types of non-US investments, the appreciation of the dollar is also lowering the relative return that we're seeing from those non-US investments.
So, quick question about that. It's always interesting to me whether countries choose to anchor to the dollar versus the euro. And so, how has the euro fared in these sorts of things in terms of being a foil or counter to the dollar as sort of the currency of choice?
So I would say that right now with the euro has gone through its own iterations of identity crisis. So Brexit, threats of Brexit, threats of other countries leaving the European Union. So the euro does not, it's still a solid currency. It's still backed by systems, policies, procedures, and so on that make it a very legitimate currency. But there is a good degree of left tail risk, right? Political risk when it comes to the euro. And in fact, what we're seeing, and I think this probably was spurred on by the euro crisis, the euro debt crisis, and so on, is really this weird cyber battle that's going on right now. So right now, I spoke about the dollar being the currency of last reserve. You just mentioned the euro, doctor. But when we think about the next iteration of currency and what people are looking to do, crypto appears to be jockeying for this position of the position of last reserve. So right now, the old standards of looking at the dollar as a reliable source, when the market crashes, that's still holding. But at the same time, it does appear that crypto and other means of payment are again challenging the dollar for its dominance at the world stage. So that's rapidly changing. And yeah, ultimately, I think year by year we'll get a clearer picture of whether it's traditional currency or some of these newer currencies, digital currencies that will kind of replace the dollar from that reserve standpoint. I think we're quite a ways away from that happening, but ultimately that appears to be the next phase of I wouldn't call it a Cold War, but we're going through this weird thing where there is this horse race for dominance at the global stage. The old days you'd have a world war where people are physically fighting. Now it's cyber hacking. Now it's through terms of trade and so on. And with the SEC getting involved with crypto, again, we will have a clearer idea in the next couple of years, as to the role of reserve currencies and what that reserve currency and preferred reserve currency would be. But the euro, relative to the US, does contain a little bit more political risk. Yep.
What do you see the impact of China and Russia trading in rubles and yen?
Yeah, so basically I would say the impact of China and Russia and their trade. Well, I'll take Russia first because that's probably an easier one right now. Russia trading with the remainder of the planet is pretty restricted, right, because of the invasion of Ukraine. Now, in China's situation, China's in a pretty tricky spot where the world is now watching China. The expectation is for China to not follow in Russia's footsteps and do anything with Taiwan. So assuming that China doesn't, assuming that China remains a good actor and doesn't go against international norms, you can expect, Chinese currency to continue to be, dominant at the global stage. When you think about China and its trade partnerships, so trade partnerships with Russia, trade partnerships with sub-Saharan Africa, other parts of the globe, that's been going pretty well without much disruption. If you watch China and the crypto markets, China has had a very interesting love affair with crypto, right? 1 minute loading up on crypto, the next minute the government's shutting down crypto. So this whole crypto race, it's kind of like the space race back in the 60s. This crypto race, I think whoever is the first and most dominant player that has the technology, that has the resources to make their currency most available in a decentralized system, I think that's the country that may win this leg of the financial system race. So with respect to China, there's a lot of unknowns. If China continues how it's continuing, keeps its head down, doesn't invade any countries, there should be some continued dominance, from China. If I'm wrong on that, or if we're wrong on that, you can expect similar sanctions and similar action to China as to what took place to
Yeah,
Russia.
but on the other hand, China has much bigger leverage on US since we owe them trillions of dollars. They are our debt financer.
Yes,
So you gotta listen to your lender.
So you do and you, this is the interesting thing, you do and you don't, right? So on the one hand, China is, I think, the biggest holder of US debt. But the other thing is, if you owe someone a lot of money, is it the debtor or the person that holds the debt that has the power? So I think there is an element of...
Two different perspectives.
Yes, so there is an element of China holding US debt actually would make them a little bit more beholden to the US, particularly if you're looking at sanctions and other things being imposed and cancellations taking place on that. So again, I would say a lot of unknowns when all is said and done with China presently. But going back to crypto and the crypto discussion, it does appear that the US, China, I wouldn't say Russia. Russia's never been the major player, but the US and China right now is like this space race for who is going to dominate the new form of currency out there. And whoever wins that, I think will have a leg up over the other.
Thank you.
Okay, so let me just jump ahead to a couple of other points. So as we think about the asset allocation does include an allocation to real estate, specifically private real estate. You'll see here under the NFI Odyssey Index, this is the area of the market that we would look to invest a portfolio in. The Odyssey Index is perhaps one of the few areas in the capital markets that saw a pretty healthy positive return in the first quarter. The fact that real estate typically has a positive correlation with inflation has helped the returns of the asset class. The fact that the stock market is less attractive today than it was a couple of quarters ago has also led to flows coming in to real estate. And then ultimately the write-downs that took place in 2020, again, going back to the theory of mean reversion, the write-downs that took place in 2020 were perhaps a little bit too aggressive. So the reversion back to value that's being recognized in some of these real estate properties does bode pretty well from a return standpoint. So real estate, definitely one of the areas that we expect to hold up pretty well for the foreseeable future. As we think about the asset allocation, that's one of the areas that we are looking to allocate the portfolio to. And then this slide here just points to real estate being a pretty good diversifier in an inflationary environment. Another area that we're adding to the portfolio is private equity. You'll see here that the numbers are as of 3Q 2021. This is because I wouldn't say the asset class, but the types of strategies in private equity are valued on an extremely lagged basis. So the most up-to-date numbers are between 3Q and 4Q of last year. The expectation is as numbers come in for 4Q, 1Q of this year, they should be a lot more competitive than what we've seen from the public equity markets. And then the takeaway here is private equity, the vintage is obviously very important. For those of you that are wine drinkers, people will talk about wine having very good vintage years. Private equity is the same, understanding that certain years are exceptional for the private equity market, other years not so strong for the private equity market. And then the dispersion between the top and bottom performing managers on this particular exhibit, the dispersion just becomes bigger depending on the dynamics of the particular vintage year that we're taking a look at. So with respect to the portfolio, this takes us to the portfolio and what have I walked through during the market environment? So the quick summary here is US equities have gone through significant bouts of volatility. Value is holding up well relative to growth. On the non-US side of things, we're also seeing non-US stocks also go through some headwinds. Fixed income is also going through some headwinds. Now in our fixed income allocation, we have core plus exposure. There are some benefits to having plus sector exposure, which my peers from Pyramis will go through. But ultimately, when we look at the portfolio, we were slightly positive for the month of March. So that's a decent result, all being said. Year to date, we are negative. However, we are ahead of the benchmark. And then as we think about the context of the broader market, the portfolio was able to perform exceptionally well relative to the broader market. Why was it able to perform well relative to the broader market? It really is the asset allocation and the diversification that we have in the portfolio. As you see here, the fixed income composite did add to the overall plan's performance. So again, plus sector exposure, definitely helpful in this type of environment.
And we were still able to do this, maintaining our investment values.
I'm sorry, can you repeat?
Our values of investment. Staying away from gun manufacturers, staying away from social ills that just don't support our community and our employees.
So with respect to the holdings in the portfolio, I would say that this is everything that we're looking at here is the legacy manager lineup and the legacy asset allocation. Mm-hmm. To the best of my knowledge, the managers we have exposure to, they are adhering to the guidelines and policies put forward and put in place. But as we are hiring newer managers in the portfolio, we'll explicitly make sure that some of the things that you just mentioned are handled within the investment agreement or the investment manager's thesis and their style. So it's a long way.
How many did we inherit that maybe are not necessarily consistent with what we've spent considerable time expressing as our values?
So I would say that, right now within the portfolio, there have been no changes to the investment manager lineup. We approved the asset allocation in February, mm-hmm. And we're in the process of going through changes to the asset allocation. So it's my understanding that the managers in the portfolio do adhere to your requirements around being out of certain sectors. This is the active managers, I should say, mm-hmm. But we do have index fund exposure, and that index fund exposure may have not direct but indirect exposure to some of those segments that you just mentioned. What we are looking to do as we implement the new asset allocation, What we will look to do is make sure that, without question, some of the stocks or sectors or companies that you mentioned, they won't be impactful within the portfolio. If they are in the portfolio, there will be some proxy voting measures in place by the manager to make sure that those proxies are voted in line with where the board would like those proxies to be voted. I didn't want to just blanket say, yes, everything is great, thumbs up, because I know that as part of the legacy manager lineup, again, the index exposures, we may have tangentially some exposure to some of these providers or manufacturers.
Okay, and so next quarter, we should be out of those woods?
So I would say as we're going through the asset allocation implementation, that's where we would look to exit out of any positions that aren't consistent with the board's values. And again, it's my understanding that the active managers are adhering.
Can that be verified? Because words like "it's my understanding" sound a little soft to me.
Yes, so it's soft, and I am putting that in place just because these
I'm not
managers
soft
were
on this. I'm not soft.
Oh, no,
on
no,
this.
absolutely. And just to my point there, I didn't want to say absolutely yes, thumbs up, because the due diligence, the selection of the managers, what the managers can go in and out of, that precedes my coming on board. So there, I'm just saying to the best of my understanding, because I wasn't in control when those decisions were made. But I will say that going forward, and as we implement the asset allocation, we will absolutely make sure that those stipulations, those requirements are clearly cut out in terms of what managers can and cannot do in terms of what they invest in. And in certain instances, there may be situations where we have, I'm going to go down a little bit of a rabbit hole, but when we think about the ESG or impact investing component of things, some managers will be exclusionary, so they will period not have these things in the portfolio. Other managers may look to have certain companies in the portfolio, but that is to get control, activist control, vote proxies in such a way where the CEO or company directives or company missions better align with the way the world should be. So ultimately, these are all things that we will address as we're implementing the new asset allocation. And again, the apologies for to the best of my knowledge language, it's really just saying we're aware of the serious nature of ESG and impact investing, but I didn't want to mislead anyone by saying, yes, it's absolutely out of this, because I know the index fund from time to time will have exposures to companies that may or may not align with some of those values that you just mentioned. But that will be addressed again as we're selecting managers, as we're replacing options within the investment portfolio.
Sure.
And with respect to the returns, again, the returns in the context of the market these are strong returns. So to give you a sense of the negative 4.5% return, I mentioned to you that the broader market, we saw a range of -9 to negative 70 basis points. The core index was down 4.6%. So we were a little bit better than the broader market, which is what you do like to see when there is a downturn. And then ultimately, as we think about the asset allocation, the addition of real estate, the addition of infrastructure, the addition of private equity, these are all segments of the capital markets that we feel will add to the downside protection of the portfolio and also be additive to the long-term returns of the portfolio.
But you did say that we were above the benchmark, even with that.
Yeah, we are above. Yes, absolutely. So we are above the benchmark. You'll see here that the benchmark was down 5.2% over the same period. So we did outperform the benchmark. And the goal here is always to, be half full in terms of providing the information. I never want to oversell good performance. I never want to make it too doom and gloom when it's underperformance, particularly when the market's going down. If the market's going down and only commodities are going up, it's only natural that we're going to go down. because we're not investing in commodities, and that's not something we'd ever recommend. So while the market is down, the silver lining here is we were down by less than the benchmark. We were down by less than the market during that first quarter period. So a tough period for the market, but we weathered that tough period relatively well, all things considered.
Okay.
So what else can we do to shield from market fluctuation?
Yeah, so to shield from market fluctuations, the key thing will really be moving on the new asset allocation as efficiently as possible.
Right.
I know that, offline, Gray and I will have some conversations regarding the timeline, the implementation, and so on. The addition of private equity, the addition of infrastructure, real estate, that would have an expectation of lowering some of the downside volatility that we've seen. It would be a buffer against some of the interest rate noise we've seen, and then concerns around inflation. Those three segments of the market typically have a strong positive correlation with the rate of inflation. When we think about the equity component of the portfolio, we're actually increasing within the asset allocation how much we have in U.S. equities versus non-U.S. equities. So we feel that over the long term, U.S. equities are still in that stronger position to outperform. And the currency effect I mentioned earlier is one reason behind that belief. The fixed income allocation is coming down, but we are still keeping 26% in fixed income. So all of these moves will ultimately, in our opinion, position the portfolio better for the long term. But the hurdles that we're facing today, I think we should be in a better position to clear them with some of these new asset classes added. So it's really up to Gray and I to again.
One thing, Chairman, I want to request that whenever we are reallocating our assets as far as the investment, can it not be just one sole point of contact? It can be more than one point of contact where we can have a consensus on where to move our assets to shield it from the market volatility.
Mhm.
Yeah, so absolutely nothing would happen without, I'll put it this way, nothing has happened without approval from this board. So let me jump to this page really quickly. I think this might help lay out a couple of things. So we've approved the asset allocation. So the board has already given us direction
That's
on
correct.
where the monies can go. So really the goal at this point is to establish between procurement, legal, and procedurally what we have to do, how quickly we can move, what information needs to be distributed to the committee and board members. But any decision to hire a manager, that would be something that's brought to all of you,
Right.
and the consensus would be
Right,
from
that's
all
correct.
of you at the end of
That's
the day.
correct.
Will be
And
brought
you would
to
also be
attention.
in contact with Gray
Yes.
in that process.
But I think my fellow board member makes an excellent point about how we get feedback. And just to reiterate, when we talk about the asset strategies, when we set these things a year ago, we really talked about how to make this portfolio do just what it's doing now.
Right.
So if we have a bad time, what's going to happen? Because when we made those decisions, it wasn't bad times. We were actually making great returns.
Yes.
And what some pension plans did was they chased those returns, which gave them a bigger bang for their buck at that immediate moment, but it left them way more exposure at times like this. We did not go for that, which is why our returns were closer to 6% rather than the 9 to 10% some other people were seeing during those boom times. But as a result, our employees' money was protected now, where some of those other funds are seeing a bigger bottom out. So I totally get what my fellow board member is saying, is making sure we have an understanding of what the guide rails are.
Yep.
And I think that goes along with saying, are we being good stewards of the money? And I think this is what I'm looking to see to prove that we made
Yes,
good
sir.
decisions a year ago.
You don't chase short-term goal, short-term hikes rather than long-term.
Yep.
It's not a 1 day or 1 year.
Good deal.
Absolutely. Yep. And again, just to reiterate, any decisions around managers in the portfolio, that's a decision that all of you at the table would make. My role would be to go through the data of the managers available, provide a short list of who's available and who would be a good fit, who would be low cost, transparent, and really, additive to the portfolio in our opinion. But we would have a really good discussion around who we want to include, why we want to include them, and make sure that everyone's on the same page regarding those decisions. And really just to wrap up here, from a performance standpoint, we take a look at the various composites within the portfolio, and we do see, within the composites, fixed income holding up pretty nicely. A little bit of downside protection coming in from the fixed income composite. The equity composite, a little bit of downside protection. The alternatives composite, I always look at it this way, hedge funds, some people really like them. I would personally say that as a institutional investor, because we can invest in real assets, private equity, real estate, and so on, these are the segments of the market that are, I think, better suited to meet the objectives of this plan. But with that being said, I'm never going to turn my nose up at a strategy that I'm looking to exit out of that's actually doing well for us. So the exit point for hedge funds has been a pretty good one for us in this environment. And then the real estate composite, I want to stress here that the real estate exposure we have presently is REIT exposure, which is REIT, Real Estate Investment Trusts. These are listed stocks of real estate companies. What we're looking to transition into predominantly is private real estate. So this would be core open-end real estate that's not traded on the market on a daily basis, less liquid, still transparent, still liquid from a quarterly standpoint, but helpful from a volatility reduction standpoint within the portfolio. And then this page here, as time goes on, we may see some names remain, we may see some names change, but what we like to put in our reports here is just a snapshot of the top performers and the bottom performers. The folks from Pyramus, you'll be happy to see A, that they're presenting today, but B, they're actually a top performer in the portfolio, meaning that they've been able to add value in this very volatile environment. I think they will do a pretty nice job of walking us through why. And then ultimately, I will stop here and see if there's any comments or questions before I kind of wrap up with some thoughts on the asset allocation and overweights and underweights relative to the approved asset allocation.
Push ahead, not Captain, push ahead.
Okay.
Yeah.
So really, these last two pages, they point to the overweights and underweights within the portfolio, specifically where we are today versus the target allocation, let's say at the end of last year. Not really surprising. The equity composite has held up pretty well relative. The fixed income composite, we see an underweight there. And the current allocation versus the target allocation, which is basically pointing to where we need to transition to or where we need to rebalance to. We see here, for example, global infrastructure, there's a 7% underweight. It's because we've approved a 7% allocation. We've yet to deploy those monies into a global infrastructure manager. You'll see for hedge funds, there's a 9.2% overweight. Hedge funds will be phased out of the portfolio and they would be used as a source of funding.
And that was my question. They are going to be phased out.
Yes, so they would be phased out. The approved asset allocation has, we'll see here on the table, has a 0% allocation to hedge funds under target allocation. So those monies would be rebalanced into the areas that are underweight in the portfolio because we're presently overweight in hedge funds. So the 9.2% overweight in hedge funds would be a source of funding for the underweights we have in infrastructure and private equity.
So could you give us an idea on a time frame for that? Because I know every time we talk about rebalancing current allocation towards our target, it always feels like I get told, we're working on it, it's going to take me 6 more months. How long does this take to do?
Yeah, so the transition to a new asset allocation, it can be as quick as 1 or 2 quarters, or it can be a little bit longer depending on the managers, their queues, and when they're able to take those assets. Also, the procurement process can also determine how quickly or how long we take in the implementation process. So again, I think realistically, a couple of quarters is typically the expectation we set with clients. And then as we're going through, whether it's an the RFP or RFI process, or whether it's a shortlist process we go through, that will again determine what extra hoops we may have to jump through to put the manager recommendations in front of you. Some clients will look to get the shortlist directly from Marquette. An RFP may still be issued, but Marquette will provide the shortlist. Some clients won't issue an RFP. It's my understanding that we will have RFPs issued, and then based off the RFP submissions, we would produce shortlists for you with recommended candidates. So again, that's something I will discuss with Gray and team, and obviously we would share that with all the board members in terms of setting expectations on the timeline and the steps that we're going to take.
So it's gonna take 2 more quarters to go from current to target, is what you're saying?
Yeah, I would say I put the word tentative there.
You're hedging a lot today.
Well, no, I put it this way: if I'm given direction from the legal folks that hey, this is procedure A that we want to go through, and procedure A allows us to really just move a lightning pace. I'd obviously take that option, but if legal says, look, it's going to be a little bit more drawn out, I would have to adhere to what legal is saying. So I don't want to come in and be all forceful and say this is how it's going to happen, because I'm aware that I have to take guidance from.
Yeah, I'd like to add, we talked about meeting more frequently rather than just quarterly, to have this committee meet, every other month type to ensure that we get the asset allocation transition done, in a reasonable amount of time. And I think the next 2 quarters is pretty reasonable. I don't think we should go beyond that, but we will need to meet more frequently as a committee.
That's the part that just seems a little challenging to me, is that we make a decision and it just seems to take so long for us to get in line with the decision we actually made.
And I would say, I don't know if it's the good news or it's just plain news without the good, but that's the process that you and every other institutional plan goes through. So it's not, you're not doing anything that you're not supposed to be doing. Typically, an asset allocation is set, it's approved. The next meeting following the asset allocation being approved is typically the meeting where any further questions are asked, and then that's when we really get the green light to go ahead. So we are moving according to what I would say is best practices, or the pace with which we move with other clients on this type of stuff. Yeah.
How fast can you come up with your suggestion for moving the funds in to other possibilities?
So
And another question related to this is, whenever we transition out from one basket to another basket, do we pay any fees in acquiring the other basket?
sure. So let me just write this. How quick, and then fees.
Because ultimately, if you are managing, the pros and cons of
Yep.
moving something to another
Yep.
comes from you.
Yes.
Not necessarily, nobody is in charge of whatever is going to happen. Nobody
Yes.
knows what's going to happen next day.
Yes.
But at least you can give us a choice that, hey, in your professional opinion, A, B, or C, or D.
Yep.
That's what we want to hear.
Yeah, so I would say that one course of action that we typically pursue, which is on the quicker end, is to use index funds as short-term placeholders, particularly in the segments of the market where we don't presently have exposure. So that's a pretty quick process. Again, procurement and the requirements around the state and the client will have to be factored in, but that's typically a very quick first step. So, the Russell 1000 growth, the asset allocation, we'd want to look at that allocation relative to the asset allocation, and then decide to move to an index fund, eliminate an index fund. That would help us move very quickly to what we call the beta exposure, which is the market exposures, and then the active managers that we look to put into certain segments. That would take a little bit more time, but that, again, it's okay for that portion of things to take a little bit more time, because questions around, adherence to impact or SRI, these are the types of discussions we want to have with those particular managers.
Okay, we want to, just in consideration of time, just want to move forward. Does that conclude?
So that
Your report?
concludes Marquette's comments, and I will be working with Gray and team after this meeting to discuss the implementation plan and next steps around that.
Sounds good.
Perfect.
Okay. Any final questions for Marquette?
One more thing, before you leave.
Yes.
Can you tell us, as far as the employees contribution and employer contribution for the last, at least, how long you been managing this?
Oh goodness. So it's a couple of quarters now, but in hearing the question, it might be geared towards the actuary in terms of contribution and the employee versus the employer amount.
What was the question again?
My question was that as far as the employees and employer contribution for the last, that's one thing I sent in the email too, that.
Yeah, we deposit it weekly, every cycle, every pay cycle gets deposited into our pension
No, but
accounts.
I asked for annual.
So that question
Yeah.
is not pertaining to
No, no,
Marquette, so we need to move on with our presentation. Thank you.
Thank you.
Sir, thank you.
Thanks, Quaco.
I'll leave the clicker right here for you.
Okay.
But we have two people, so if
Yeah.
you want to come on this side, I'll present.
And this is the fixed income investment, investing philosophies and strategies from Fidelity Investments. I think we have Bo and Sarah, correct?
Okay. Hi, I'm Sarah Weddleton. Thank you, the relationship manager for your account. So that means I'm your direct contact and Marquette's direct contact. Thank you very much for your continued relationship for over 15 years. We just hit that, so thank you very much. I'm joined with Bo Koash, institutional portfolio manager. We were here a couple years ago, so it's nice to see some familiar faces and some new faces. And I'll turn it over to Bo to kind of go through Core Plus, our environment, the team, philosophy, performance, positioning, and outlook, and please interrupt with any questions.
Great. Hi, everybody. So let's just start out with what is the Core Plus strategy. We've got a diagram up on the board. On the left-hand side, you can see all the classic fixed income asset classes that we allocate to. We have a bit of a specific mandate with you all where we don't have global bonds approved. Those would be global high-grade bonds that are a little bit less interest rate sensitive because they're off of euro curves, sterling, and the foreign curves, so which aren't going to have the same growth rates as we will have here in the U.S., so not as interest rate sensitive, but we hedge those all back to USD. Those are all the choices we have for the investment grade pieces. And on the right-hand side, we've got the plus sector approach, but we never got leveraged loans approved with this plan. And so I think when we last came here, we asked if we could try to get that approved, but we just have never gotten there. That would be a nice one to add at some point. Global bonds would too, especially now is a great reminder of interest rate sensitivity and how that can go against, especially this year with the negative returns, has been all based on interest rate sensitivity. So the way we typically operate, and we also have a Core Plus Light approach. So this says 0 to 30%. That's our typical Core Plus structure. It's for this plan, we're at 15% max, so 0 to 15. But the real band is somewhere in the 7 to 12%. We typically don't spend the whole plus sector because if we have a drawdown in credit or in another asset class that we can choose from, we tend to like to go slowly, gradual contrarian mentality versus betting big and potentially being really, really wrong or really right. But that tends to get you to the bottom decile or top decile. And what we're trying to do is be top 30th percentile in every market period. So this is just a good diagram to start with. So let's just keep moving here. This is the team. We've got you can see in the industry and when they started at Fidelity, Ford O'Neill is the lead portfolio manager for this portfolio. You can see he's been at Fidelity since 1990. He's been a portfolio manager since 1992. I've known Ford since 1993. When I was covering Fidelity, I was at Lehman Brothers in corporate bonds. We created the indices, so we know the indices very well. But this is the team that manages the portfolio.
Question,
Yes.
where are y'all based again?
We're based in Merrimack, New Hampshire. The fixed income team is in Merrimack, New Hampshire. That's the high grade team. Our below investment grade teams are all in Boston.
And are there any New Orleanians in there?
Excuse me?
Any New Orleanians in there?
No New Orleanians in here.
So my question is, as a 300-year-old city that's 60% black, led by a black woman for the first time in 300 years, when I see a list like this, I want to see opportunities for our children, not just our money. So explain to me how this represents this city being served.
This group is not representing this city. If you came to meet us, you would say this group itself, this small portion of our fixed income team does not represent, but we report, all the PMs report into CIOs. We have 2 female CIOs. One is an Asian woman, and another one is Caucasian woman. So we've got,
Again, this is a 60% black city
understood.
that's led by a black woman. We have children that are interested in finance and opportunity. And one of the things I want to do is make sure people don't use our money to make money, but use our money to reflect our citizenry. So I'm sorry to be very focused, but when I see a list of people that are not New Orleanians, very limited opportunities to engage black people like me to get jobs, I have questions about access. And so I want you to walk me through, when you're talking about teams and philosophies, how my children will have access to this.
Okay, well, we have programs where we're recruiting actively to get underrepresented groups.
Where do you go?
We now open it up. Anyone can apply to Fidelity to get any.
What historically black schools do you visit?
Excuse me?
What historically black colleges do you visit?
We don't visit any college now. We open it up. We open up to all colleges to apply.
So I guess the reason I'm pushing pretty hard here is that passive solutions don't work for me. Thinking through saying we have an Asian woman is saying like I have a black friend. I'm not interested in that. So this city represents my employees here, our employees here. They're hardworking people. They provide for families and generations. Have some of the highest rates of home ownership in the world here. And that comes from opportunity. So you all are investing a significant portion of the opportunity my employees work for. Where's the opportunity for their children? So are you clear on my question?
Yes.
Very much clear. And we in the past, I mean, very late to the game, but we've created a diversity and inclusion report that's available and I can share with you. We started over the past 2 years. We've been fortunate enough last year to, given customer demand, we've hired over 16,000 people, so our percentages have gone up, which is great, and we can share the numbers with you. But back to recruitment, we do go to colleges. We even start as young as high school as well.
Well, he just said you don't go to colleges.
I know, I'm not sure.
Well, for certain
I don't
analysts,
know the names
for
they
certain
are, but
programs,
do
we don't
recruit.
go out.
So, but part of what's confusing to me is if you say you're looking for apples, you have to go to an apple orchard.
Yep.
So if you can't tell me how you're actively working on making this different, that sounds like something that hasn't been thought through.
It has. Unfortunately, I don't have the exact answer for you. It's a 40-page report, but we certainly do.
I've got 2
programs
pages. Can I
and-
bring these over to you to show you the improvements we're making on recruiting?
Sure, we can do this
We can
after
do
the
it.
meeting. I won't help you.
So we've got
have everyone's time.
we got 2 pages that have strong trends on and hiring.
And just to reiterate that point, this has been a constant concern, and it has been a topic of discussion for this committee
Right.
over the past few years. And it is significant, and it's an important factor in terms of us having to address it and get a response that indicates strongly to us that there is a strong move or some strong resolution to ensure that we're represented. And that's the nature of what Dr. Scholas is talking about and what we want to achieve.
Yeah.
So we just want to put that on the table.
and I can confidently say, yes, Fidelity does as well. We will do better, and that's a commitment that we have made across our entire organization. And we're holding ourselves accountable by year-to-year numbers that you can actually see to show what we're doing to improve.
And you can share that with you.
Sure,
Yeah,
thank you.
Got some of those numbers today,
I'll
so.
follow up. if
Sure.
that's
Okay.
but yeah.
Thanks.
So I think we've got the team. Any questions on the team experience? We can go past that. We're trying for, and I already talked about this gradual contrarian approach, where we are consistent performance, consistent alpha over market periods. You can see our relationship going back to 2007. That was right before the financial crisis. So those longer term numbers aren't as good as the 10-year numbers, because that was the big drawdowns back in 08, 09. But slightly off of our goal. Our goal is to get 100 to 125 basis points of alpha on an annualized basis. You can see that we're hitting those numbers pretty consistently through almost every period, starting in the 1 year, 3 year, 5 year. In good markets and bad markets, you can see the negative absolute returns on the 1 year and even the 3 month, but we're outperforming from a relative perspective. And then the longer term numbers. Does that make sense? This is the contribution to return, and obviously the 3 month and the 1 year just shows where the negative returns are coming from. This, as was mentioned earlier, has been a 3 or 4 standard deviation event in terms of negative returns for fixed income, given that the Fed is now raising rates pretty aggressively, and it's just bond math. When you have a starting yield at on the ag of 1.2% starting yield and a long duration of close to 6, if you've got that math turns into big negative returns if you go to a 3% Treasury 10-year pretty quickly. So this is what you're seeing now in the returns. The good news is we've talked a lot about the bad returns so far in fixed income. We think a lot of this is obviously already baked into markets. And given that we're now a much higher starting yield from this point, from today on, that we have a really hard time coming up with negative return scenarios from now until end of year, just given our starting yield. In this portfolio, I'll get to it in a second, we've got much higher yields, a couple hundred basis points higher than when we started the year. So and this is the portfolio. So let's just go through some of the items here. I'll just hit some of the highlights, but you can ask questions on any part of it. The yield of the portfolio, this is as of the end of March at 376. It's closer to 4.3% now. The ag is started the year at 1.2%. So you can see that the starting yield is a lot higher to help cushion the blow of any negative returns from here. So we're starting at that much higher yield. You can see the duration is slightly underweight, so that's helping us perform relative to marketplace, relative to the ag, which is the benchmark. The U.S. Treasuries is a pretty big underweight at 33.5 versus 39.4. The QE program is over, so the Fed is no longer buying back Treasuries, and also, the Fed is planning on getting their balance sheet down from 9 trillion to 6 trillion. So that's 3 trillion coming out, which means that they're going to be potentially letting that roll off and or potentially selling Treasuries, which is part of the reason why the markets are reacting the way they are, is the fear around that. In addition to that, it's lack of foreign buyers. We're seeing Japan really pull back, potentially China. And so you've got a lot of issues with supply demand. And on top of that, banks in the U.S. used to buy a lot of agency mortgages and treasuries because they couldn't make loans. They weren't making loans because the bank loan market was intervening and actually taking a lot of the issuance away from banks. So they weren't making real loans. Now they're being asked to make loans on inventory build, which makes sense because now companies have to rebuild their inventories after the slowdown. So all of a sudden, banks can make money, they can make fees, they can make a good return on their loans by loaning against inventory. So banks are actually should be more profitable, but it also means there's less demand for U.S. Treasuries from banks as well. So you've got a lot of factors that are pointing at less demand for treasuries, and above and beyond all that, the deficit's not going down, so the Treasury still has to print a lot of U.S. Treasuries, so that's more supply into Treasury market. So there's a lot of pressure, which is why we've gone from 1% yields in 10 years out to 3 and change percent in 10 years. And we think a lot of damage has been done. We're not calling an end to it yet, but we're getting close. Our next trade will likely be to start adding back some longer duration treasuries into portfolios to get that higher yield back in the portfolio. TIPS, we're currently at 0%. We did make a lot of money for you in TIPS at the peak of just after COVID struck. Break-evens, which is the inflation, basically the intended inflation rate was about 100 basis points, even lower, so 90. That's the market saying that the Fed's, the CPI was not going to be more than 90 to 100 basis points. So everyone was betting against the Fed hitting their targets of 2+% in inflation. So we bought about 6% in TIPS at break-evens of 90 to 100, and we sold the break-evens at 250-ish. The last trade was to the Fed buying program. They're no longer buying TIPS, but the last trade was the Fed buy program in November 2021. And the TIPS market can be very illiquid, especially with the Fed not supporting that market. It could become more illiquid. So you could burn through a lot of performance in TIPS just exiting now, because what the Fed hasn't fixed is the liquidity in the fixed income markets. So TIPS, off-the-run treasuries, agency mortgages, all those items got very illiquid back in March 2020 when COVID started creeping in. And we got really concerned by mid-March because we didn't think we'd have enough liquidity for equity players or for our asset allocation players to sell fixed income to buy equities because there was just no liquidity. And we're kind of back in that same, this is why yields are going higher pretty fast.
So how is this being affected by the great sort of resignation and sort of retirement that's happening? Because I feel like you have to be liquid to be able to honor those people tapping out the system, right?
It's certainly liquid enough. But instead of having execution at a couple of ticks, which is like a 1/32nd, very tight markets, you've got to operate within 4 or 5 basis points on some of these names. So when I'm saying liquidity, it's not that you can't get something done, but there's more friction, there's more implementation cost when you're trying to trade these treasuries, agency mortgages, and sometimes for super off-the-run treasuries, you could pay a lot more than a couple of basis points. So what I'm saying is it's still open, and dealers have to make markets, but they can make markets at wider levels, and that's the cost of the current market structure. And I have a slide that will demonstrate why we're in that position today, given the balance sheets of Wall Street. I can just talk to it now. The balance sheets of Wall Street in 2007 were massive. They were also had a lot of problems because they were taking a lot of proprietary risk for their own prop desks. They were 35, I know Lehman Brothers, we were 35 times levered. Other banks were 25 to 35 times levered. All that got reduced to 8 times leverage. That's why we had a great opportunity to buy product back in 08, 09, because all of Wall Street was getting way down in their balance sheets and selling things because they had to sell them. All the risk managers were tapping all the traders on the shoulder. You got to get down on risk. You got to get down on risk. Our target is 8, not 35. All that selling we benefited from because we were buying it at very cheap levels. Okay. So that's really the drive. That's more the driver. So that's the tip story. Credit, you can see that that's a few more lines down. We're still overweight. We probably would not have that overweight if we had access to leveraged loans. We probably would have that overweight in credit into levered loans. Probably would have had 20-ish, 30-ish more basis points in performance had we had that, because in all the other Core Plus portfolios, we have a decent allocation to levered loans. But still, we like credit. Credit is, in 2020, we added about 1,000 basis points in credit. Companies, high-grade companies, were able to come to the marketplace. They were forced to roll out of their commercial. They couldn't roll their commercial paper. So the Fed made it very easy for them to come to the marketplace by promising to support corporates. So that gave a lot of confidence to the marketplace. Companies, high-grade companies, single A's were writing paper at 4 times what they could get today. So they were writing very cheap corporate bonds. We were buying almost every one of them. We were one of the early buyers in that period. The March 16th week, the March 23rd week, the next week, all the way through June. We bought about 9 out of every 10 deals. We added 1,000 basis points. We made somewhere between 30 and 40 points, so up 30-40% on many, many names. So it really added a lot of value. And then when we got to June, July, August, spreads rebounded back to where we normally are, and we started selling those long duration assets back to the marketplace. So we did a full circle on that. So that's why we've been able to produce this performance year after year. We take advantage of these drawdowns, and we do it systematically. And we've done it in 08-09, in 2011 European crisis, 2013 taper tantrum, 2015-16 energy crisis, 2018 Fed misstep, and the COVID crisis. Does that make sense? Securitized is another source where we fund the plus sectors, agency mortgages at basically a little bit about half weight, 14.76, so an underweight of 1,200 basis points. We have not been a big fan of agency mortgages. They've extended, so they're one of the worst performing sectors in the high grade space because they're small spread, and then they've extended in duration. So just in the last year, they've gone from a two or three duration out to 6 duration, which is a big move. They doubled their duration, but they're still only about 50 basis points of spread. So you're not getting paid to take that risk. So we've been underweight that and not looking to cover that anytime soon. Probably cover the Treasury short first and then some. CLOs has been a big allocation for us. This is a collateralized loan obligations. It's a structured product. There's been over 6,000 CLOs done, and none of them have failed. And we only own the AAA piece, and it's a floating rate security. So that's obviously done very well in this environment because it's given us a positive return. And then we've got the high yield EM and the high yield CMBS, which is a small allocation, but it's got about a 9% yield on it. So it provides a lot of yield for the portfolio. I'll stop there just for a second to see if there's any questions, and I'll hit some of the other highlights in a second.
You talked a little bit about utilities being a potential good place to be in these volatile markets. Is that something you all have leveraged and utilized, or did I misunderstand?
No, I didn't talk about utilities.
No, in that previous presentation.
Oh, okay. I mean, utilities probably in stocks are a great place to be. In bonds too, there's certain names that are very good.
Okay.
We've owned Entergy before. We've owned a lot of great utilities. It's all based on relative value, but utilities is a very small part of the market. You can see it on the right-hand side. It's only 1.87% of the index. So it's a very tiny, it used to be a huge part of the bond market, of the corporate bond market, but it's gotten very small. They tend to do more project finance and off-balance sheet type of fundings for their capital needs. Does that make sense? Our biggest overweights, banking and REITs. Banks are in great shape. They don't have the leverage they used to have. They got regulatory all over them. They can't pay out a lot of their dividend. So at banks right now, the yield curve is flattened dramatically, but they can still make money because of the items that we talked about before about the loans they're able to make. They don't need the Treasury curve to be steep anymore because they're making great loans. And the 3-month has still got a good curve out to the 2 years. So the 3-month Treasury, or the very front end where they tend to borrow most, is still got a nice curve to it until the Fed starts moving another maybe 100 basis points or so. REITs, we have a lot of REITs that are, technology REITs, medical REITs, also infrastructure REITs for distribution assets. So for Amazon, that's been the hottest product in REITs. And those are all, we've got a great team. We have one of the biggest REIT groups, equity and fixed income out there. So we look at those very carefully. And then if you look down the bottom right, AAAs at a big underweight, That's the most interest rate sensitive part of this portfolio. So obviously this is one of the reasons why we're able to outperform. And then the single A, but more so the triple Bs at about double the weight of the index with the below investment grade piece as well. I'll stop there and see if there's any
Any
topics.
questions?
Yes. And how are we doing on time?
Let's move along.
Yeah, so I can stop, I mean.
No, just, go ahead.
Okay. So I think, we talked about the curve. Let's hit, I'll hit this first. This is your portfolio. This is our active duration betting. And this will show you, this will demonstrate on the right-hand side, just focus on the right-hand side, our contribution to treasury duration, our contribution to corporates duration. If you look on the left, we were underweight treasury duration until the March 2020 period. You can see the blue line there that then dips hard, and then the green line picks up. That was our big contribution. That was our big buying in corporates. But if you take a step back, I just wanted to point out the other drawdown was the Fed misstep in December 2018. We did the same thing. We sold treasuries and bought corporates, and we bought high yield in that drawdown. So that added a lot of value, which is why our 5-year numbers are pretty good when you get those two big opportunities within the 5-year number, if that makes sense. And now we've taken all that down, so the green line has come down, so we took a lot of volatility out of the portfolio and dampened. Now we're very well spread. We don't have a lot of outlier bets in the portfolio. This is the kind of market where we can't really have a lot of conviction and pound the table that things are over, because we have a transition period is always sloppy, and we have to wait to see how the Fed reacts to data that's not that great in the economy. Nobody really knows what real CPI is. Like Quay mentioned, Russia being an issue from an inflation perspective. China is as big an issue given their lockdown. And the famous graph I like looking at is the one with all the boats in the harbor outside of Shanghai. Now, when they start reopening, we talked about that in our LA port last Christmas. That you don't hear about that much anymore. It'll be time for that to clear out in Shanghai also, and now they're starting to unlock in Shanghai. So we're hoping, but hope's not a strategy. So you just gotta stay diversified and wait for opportunities. But that's why we're not in a rush to do any asset allocation within this portfolio anytime soon until we start seeing levels and behaviors that we think are interesting. Maybe the 10-year now, the new target is probably 3.5. So if we get the 325, we might start adding some 10 years, and then maybe at 3.5, we add some more, for example, but very gradual because you just don't know. Does that make sense? A lot of this was covered already, but let me just talk to, I think wanted me to go through a little bit on the yield curve. You can see this is a few different points on the yield curve shape. You can see the first step here on the blue line, kind of up there at the just above the 1.5% treasury yield. You can see the curve is pretty well behaved, which means that you got a positive slope curve, meaning that the front end rates are below the long end rates. That's typical. That's a very typical curve. And that was pre-COVID. That's December 2019. That's pre-COVID. The VIX, the market was very well behaved. You had very low volatility. That's a very typical curve in that environment. Then the second is basically, right after COVID hit, but look at how far front end rates came down all the way to zero. That's that gold line. Mm-hmm. And so that's basically what happens when the Fed takes 150 basis points out of the marketplace, which is what they did. That's why we got great performance in 2020. We're high single-digit percentage returns. In 2019 and 20, we got about 4 years of returns for 2 years of operating the strategy. So you got more return than what you should have, but we knew, given that all the yield had been rinsed out of the marketplace, that if we start rising rates, at some point we'd have to give all that back. And that's what's happening now. That's why this year is so dramatic, because we're just giving back a lot of that performance. The next piece is the end of the 2021, which is kind of after COVID has been played out. We're starting to get back to work. It's just a little bit after the things are getting back to normal. So that's a steeper curve. And then The last one, and that's also pre-Fed getting ready to go because rates are low, economy's coming back, and then the next curve, the black curve, is the inversion from twos, or at least flattening in twos and out the curve, with that front end still being tethered because the Fed has only done 75 basis points, and now we're waiting for much more. So this is the few shapes, and we expect that the curve to be even flatter after a couple more Fed meetings, probably with another 100 basis points added to the front end of that curve to really flatten it out. And it could be a parallel shift out the curve. I'm just gonna do this one just because it's a little bit less of an eye chart. If I showed you this chart, and I'm just gonna point to yield rank and spread rank. So these are different asset classes within the high grade and below investment grade markets. And if I did a yield rank and a spread rank last year, that would all be in the 20th percentile. So the tightest levels we've seen, like among the 20th percentile tights that we've seen. So not much opportunity in fixed income. But today, given that the Fed is raising rates, all of a sudden we've got yield ranks that are in the 90th, because the last 10 years has been pretty tight rates, pretty low rates. All of a sudden we've got much better opportunities. So we're actually getting much more excited about the bond market now, even though we've had a bad few months. There's better opportunity because we have more cushion in the portfolio. We can get better yield for our clients. And so I think this is what we're talking about now with clients, is that we don't know when the time is to add a lot to it in terms of yield, but so far we are much more excited about the bond market than we were back in January, when we were much lower in yields. But look at the yield ranks, and now the spread ranks are still not that attractive yet because you want to see them much wider. But if you saw this we saw this last year, every one of those numbers would be 20 percentile or lower in the single digits potentially. So the opportunity set's getting better. This is a conditions index. I suggest you follow this one really closely because this financial conditions index is a Goldman Sachs index they came up with, and they're measuring corporate access to capital, sovereign access to capital, both in equities and in fixed income across the board. This conditions index has never been below 98 in its history until the 2020 and through 2021. And so it was in the 97 handle through that period. We are, and then it's kind of touching 98 there, but we're now at 99 as of today. So that's getting more attractive. When it gets to 100 to 101, that's when the opportunities will be. The Fed has done their job. So the Fed is trying to make this index go up by making it harder to get access to capital so that we get inflation tame. Companies won't do as much CapEx if costs are higher. Access to capital is tougher. These are some of the things. This is the Fed kind of fighting inflation, getting rates higher, slowing things down. And this is kind of one of the things they're looking at closely. So I suggest this is a great index to watch because this will correlate very well with VIX going higher also. And then the MOVE index, which is the fixed income or rates moves, is also at its highs right now. It's double what it was a year ago. So watch all those things in tandem, and that'll give you a sense of when we'll probably be operating and adding more risk to the portfolio. Does that make sense? This is a little bit of an eye chart, but this is a little bit of the, I'm going to follow along with Quay's comments, but the dotted lines across are the average 2s 10s curve. So the green dotted is the average 2s 10s curve. The blue dotted is the average 2s 5s curve. You can see it, 114 basis points on 2s 10s. That just means a 10-year yield minus a 2-year yield. That's it. That's 114 basis points on average over that period of time. And that's from the early 90s. And it's 60 basis points for the 2s 5s, just to, 5s minus 2s. But you can see how much volatility is in this market. Curves, if it's really high, if those graphs are high, that means it's really steep. And then when you burst through down below, that means they're really flat. And as mentioned, it can be a predictor for economic recession. In 1992, 93, the Fed moved 8 times between 92 and early 93, and moved about 350 basis points. Didn't cause a recession. Did cause a recession when we got into but it was delayed. That 07, 08 period where we got really flat, and then into the 1920, but that was COVID shutdown. So you can't really blame that on rates or attribute it to the rate structure. So you've got a couple of, it can predict it, but it's also, you got to really step back and understand what's going on. We were coming out of recession back in 1992, 93. Fed wanted to slow down the speed of recovery, so they moved that many times. We still had a pretty good year in 1994, 95, even though we had negative returns. And that, because we started with such a high yield, the ag was a negative 2.65% instead of today, negative 5.9%. It's even less negative, more negative now, given performance month to date. We'll see how the rest of the month plays out. But this is a good graph to show you, steep, flat, steep, flat, steep, flat. And then currently we're pretty close to the averages, and we'll see what happens from here. But I think that's a good graph just to keep an eye on. And this is the last one I'll just talk to. The blue line is the amount of balance sheet that Wall Street has for corporates, high yield, and commercial paper. You can see that peaked. I talked about it a little bit in 07, 08, come down dramatically. But look at the size of the bond market. It's gotten much bigger. It's gone from about 1.9 trillion to about 8, so it's about 4 times the size. This is why we get opportunities, because there's always a big seller of fixed income somewhere. We just have to figure out who it is. In 08, 09, it was Wall Street. In 2011, it was sovereign wealth funds, hedge funds. In 2015, 16, it was sovereign wealth funds who were already long energy because they were making it, but they couldn't sell oil at a good price, so they sold their risk assets to fund their budgets. And then, in 2020, it was companies needed to fund themselves to get funding. Now they're funded for companies in high yield and high grade are now in great shape from a funding perspective. They don't need more funding for another X amount of years because they're already locked in. And so this is why we get great opportunities. This is why we'll continue to be in a flexible portfolio like Core Plus. This is a great slide as a proof statement on why we can add a lot of value in addition to that volatility of the interest rate movements. And I'll stop there to see if there are any questions and wrap it up.
Okay. Any questions from committee members? Okay. Thank you, both.
Thank you.
Sarah.
Yeah.
Okay. Moving on, we have one informational item, the supplemental performance report, of course, from Marquette Associates. Any public comments?
No public comment.
Okay. Just one additional comment I want to make, just in terms of the presentations, Greg. I want to kind of sit with you and then bring back to committee. There's a lot of information contained in these presentations. Try to figure out how and if it's wise to talk with each presenter or our managers or consultants, just in terms of how to consolidate or to present maybe more concise, to the point for discussion and presentation. Is that possible?
Yeah,
We can
understood. It's a
sit and do
good
that.
suggestion to make it digestible. Yeah.
Okay. No public comments.
So we're ready for
I'll
adjournment.
take a motion for adjournment.
So moved.
Second.
Sir, before you move to the adjournment, I wanted to discuss that item which I talked to you about the vestment period.
What I'd like to do is really discuss that with you, but I don't want to move
Okay, that's
on the
fine.
agenda today, but I do want to discuss that with you.
Thank you, sir.
Okay.
We
Okay,
have a motion.
we have a motion and a second.
Second.
We have a motion and a second. All in favor?
Aye.
Opposed? Meeting is adjourned. Thank you so much.
you.
Thank you,
Thank
Fidelity.
you.
Thank you, Quaco and Marquette Associates.
You all have earned 1.5 hours.
Weekly, every weekly payroll cycle.
Cumulative numbers, surrounding pieces, I've been hearing the nothing to But I've been.
Exactly.
I've been underfunded.
But, I mean, that's a percentage of the actuary disputed. That's not a fact. That's not a disputed number, that's just like a number. 70%.
Where is the gap? Why are we not making our financial obligations?
Yeah, I guess the funding policy was aimed to increase the percentage over time to